Hi, so my name's Roy Thompson. I head up Carpenter Box Financial Advisors. I've got with me Henry Wilson from LGT Wealth. It's been a long time since we did an investment update, and in part, that's because the world has moved on so quickly in the last few months. What is true is that we've got a crisis in the Ukraine. We've got inflationary issues here in the UK. And I thought it would be sensible to start up the video series again, just to get a bit of an insight about what's happening, if you like, at the coalface. So from an investment manager's point of view. So Henry, without further ado, I guess, as an investor, big news really is around inflation, as it has been for some time. If we go back a year, I think we were perhaps doing these investment updates and we were starting to talk around inflation. People were worried about what would happen. And what we've seen is inflation move from being what the Federal Reserve in the US described as transitory, as in it would go away in a short period of time, to being a little bit more what we might call entrenched. So, it's here to stay. And inflation is really affecting interest rates. That's the thing that's driving interest rates. So to try and perhaps unpick all that, where are we with, perhaps where we are with inflation today, where economists think that's going to go to, and the impact if it sort of overshoots where economists think it might go, or if it undershoots where economists think it might go. I don't know if that's too big a question.
Yeah, so I think that the first caveat that I would add is just that economists are not very good at doing very precise kind of estimates, I guess. So yeah. Everything that I say in terms of these estimates, they're subject to change and variation. But it looks like the UK it will probably peak at somewhere around kind of 10%, yeah. And that'll be around October this year. The rest of the world, it looks like, and when I talk about the rest of the world, I mean really Europe and the US. It looks like it'll be peaking in around May or June this year. So the hump should come a bit sooner for Europe and the US. In Asia, a bit more nuanced. It feels like inflation there is not such an issue. They didn't have to go through the same very extreme policy measures that we did throughout COVID. So they're not dealing with that enormous demand supply imbalance that we have in the West. But you raised a very good point about the risks to the upside of inflation, and that's very much a big concern for investors, that if it goes from kind of 10 to 12%, that would obviously be painful for portfolios, not just because it would be likely that bonds would suffer, but also some equities would suffer. The reality is, however, is that because of the way that inflation is calculated and things like base effects, it's quite unlikely that inflation will be able to ratchet up again and again and again, because if something goes from a 100 to 200, for inflation to go up again, it would have to go from 200 up another level. And we're seeing it a bit with if you take oil or energy prices. Energy prices have already gone up quite a lot, so they would have to go up again for us to see inflation go up. That's one part of the inflation component. But in actual fact, we think it's probably more likely that we'll see energy and oil come down over the coming years rather than go up again. So those base effects come into play, and the way that inflation is calculated, we have to remember that it's growth on growth would lead to that rise. So October time for the UK, and we might sit around 10%, a little bit over, but the market is now pricing a lot of that in, and so that it's more likely that we see less rather than more.
Yeah. So I guess what some people might ask is, being UK centric, why would inflation in the UK lag, for example, the US or Europe?
In terms of the timing, it's really to do with the fact that we have this the price cap on energy. So energy suppliers are only allowed to raise their prices at certain intervals. It's every 6 months, and they have to get it's kind of a regulated amount that they can increase their prices by. In the UK, the first one rolled off in April, and there's another one expected to roll off it will roll off in October time. Yeah. So it's just that is part of the course. In the US, they don't have those same caps, and they're also slightly less dependent on oil and energy from elsewhere. They're actually mining net exporters rather than importers. Yeah.
So from an energy point of view, really it's the energy aspect of it, and the fact that we got the price cap that means consumer gets a delayed effect of that, in essence, of some of the energy
Exactly.
issues that are there. Obviously, the position in Ukraine is a humanitarian crisis, clearly, and that's been much described. I guess big things would be the fact that Russia is a big oil/gas supplier, Ukraine food sources, some of that really difficult to unpick, and really difficult to understand how that might affect the markets. I don't know if that's a fair statement.
Yeah, so it's one of the byproducts of everything that's been going on is suddenly everyone becomes an expert in supply chains around things like food and oil and sunflower oil and wheat, and we spend a lot of time kind of thinking and analyzing and trying to understand the knock-on effects of everything that's been going on. But as you mentioned, it is first of all a humanitarian crisis. So, but we obviously have to think about the financial aspects and the impacts that that's going to have on portfolios. So, it does look like it's going to be inflationary. The impact in terms of food and Ukraine is known as the breadbasket of Europe. It's a massive supplier of sunflower oil and wheat and grain, particularly to Europe. And then there's the oil and gas side. So you would have seen that Germany is a net importer of around 70% of natural gas from Russia. So that's been very much on our mind. And if you kind of break it into different spheres of the world, you've got kind of the US, Europe, and China. I'd say the US seems most insulated from ongoing events in terms of Ukraine and Russia when it comes to food and energy, primarily because they're actually minor net exporters rather than importers.
Yeah.
Europe is much more exposed to those things. They import a lot of energy, oil, gas, and food, kind of agricultural commodities. China, we might see that they're actually beneficiaries because they can get access to cheap oil and energy from Russia. And when it comes to things like fertilizer and grain and agricultural commodities, they've got a massive amount of strategic supplies that they've had in reserve. They've been building it up since around November 19. So kind of quite interesting to see the dynamics in the different regions. I don't think it's clear any one way or the other. And clearly events in Ukraine in terms of the war will determine how much they're able to export. They've actually still been able to export certain commodities, so it's not been a complete kind of shutdown, but we continue to keep an eye on things, and you just begin to realize things like fertilizer that we use to plant our agricultural commodities in the UK and in Europe, well, we get that from Russia and Ukraine. So it's having knock-on effects for sure, but things are still bubbling away in the background.
And then to add to the inflationary issues, as you alluded to before we started recording here, not helped still by perhaps China's approach to COVID, which is vastly different from what we've experienced here in the West, where yes, accepting that there are risks in day-to-day life that weren't there a few years ago, by and large, everything's open. It's back to normal to almost. You might say. So China's still a long way off from that, which is creating or helping that supply issue, as I understand it.
That's exactly right. So we're learning to live with it, I guess, is the phrase. In China, they're taking a zero tolerance approach towards COVID, which really means that the ultimate aim of the authorities is to literally have zero cases of COVID. And part of that is to do with the fact that they didn't have the same levels of herd immunity that we had in the West, from kind of where perhaps we didn't lock down in such a stringent manner, but also their vaccines are just not nearly as effective as the Western vaccines. So those concerns have led them to take quite an aggressive stance towards locking down. You would have seen that they've been barricading people into their houses. Yeah. They've been installing kind of temporary fencing on streets and around residential blocks. So it's been quite aggressive, and the net effect of that is that people have not been able to go to factories and ports and things like that. And we're all well aware that China is a massive manufacturer and it's kind of a massive producer of goods and items for us. So it's having knock-on effects. And I think quite a good one that I heard about the other day is Volkswagen. They put a lot of their parts on trains from Volkswagen, and they send the parts on the train line through Russia, and it arrives in China. The parts get turned into cars, and then they get distributed back to the West or into Asia as kind of made up vehicles. Obviously, because of the Russia-Ukraine war, that train can no longer go through Russia. it used to take about 6 days, and it was very efficient, effective. They just knew 6 days, bam, here. It now has to go on a container freight ship and be shipped all the way around to China. Clearly, shipping is much less effective. It's more expensive. It's more energy intensive. It's less reliable. And they're getting to these ports, and there's a huge amount of congestion in the ports relating to these lockdowns. So it gives you a real idea of the difficulties facing different sectors and industries, not just because of COVID in China, but also Russia and Ukraine. And that's one of the reasons why we're a bit cautious on European equities at the moment, and in particular those big manufacturing nations like Germany, and where the automotive industry was already on its knees because of supply chain constraints. We're seeing these, we're having further knock-on effects, which is impacting economic growth.
Interestingly, a friend of mine was looking at purchasing a German car. It was actually an Audi, and they referenced it would take 18 months from order to delivery. So, quite unbelievable, ridiculous. I guess. And of course, it's a common refrain now, isn't it? Oh, everyone blames COVID. And, I think that we have to remember, once we start trying to understand it, in a lot of cases, it's a genuine, it's a genuine position, and it's just frustrating, sadly. So as an investment manager, you referenced there, avoiding Europe, and I guess what you're really saying is that has the biggest impact of what's going on in Ukraine, Russia. So the energy impacts that creates most adversely affects Europe. What do you do? Because I guess some people are buying up commodities. Where do we stand here? Is that a sensible thing to be doing, or is that a higher risk strategy? How does that look?
Yeah, so it's a really good question. So by gosh, we wish that we had 50% of the portfolio in commodities coming into this year. But, reality is commodities it's a very risky game. They're very volatile. 9 years out of 10, they'll probably lose you money. There might be 1 year where they make a lot of money, but you're getting a hell of a lot of volatility or, variability of returns over the course of the year. It's a really risky asset class, to be honest. And the other thing is that it's very much impacted by external factors.
Yes.
So commodities as a whole, they're impacted generally by and large by things like economic growth, inflation. But then, we've seen things like the war, the Russia-Ukraine war, and it can be whether China's being a big buyer or not. So many things that play into that, the drivers of commodity returns that make it quite hard to understand whether it's going to go up in 1 year or not. And there have been so many times over the last few years where someone said, oh, we're going to have the commodity super cycle, and then within a few weeks it's fizzled out and people have lost a lot of money. And I think from our perspective, if we're trying to if I would say to you, will the price of oil next year be $150 a barrel or $50 a barrel? Or, would it be closer to that? I think it's 114 today. It'd be a flip of a coin as to whether it's going to be 70 or 80 or 140. And so in many ways, it's a little bit like gambling, particularly when you're trying to take a slightly longer term investment approach, which is what we're trying to do. We think really when you're investing, you need to take a kind of 3-5+ year view, because everything shorter than that just becomes too much of a gamble. So we're not doing that really. What we're trying to do is buy high quality businesses that over the long term, we just understand their business model. We know that we can say with a pretty high level of certainty that, over a 5-year view, that Microsoft or Visa or MasterCard, their earnings will go from here to here. And so we're happy to take an investment approach on that. Yeah. That said, we have been reducing the exposure to some of the funds in the portfolio that were slightly more sensitive towards inflation and towards interest rates.
Yeah.
So where we felt that they might be under more pressure if inflation continued rising, we felt that it was prudent to just take a bit of profit out of those names and allocate towards some of the parts of the portfolio that were slightly less sensitive, that might go up if inflation goes up. And that's just about kind of portfolio construction, making sure that the portfolio is slightly more robust and is prepared for slightly more eventualities. I think that's the main idea.
So if I think about an end consumer client in my circumstances, who's got money already invested, well, actually in the very short term, week by week, we can well expect what we would call volatility. So we could get some good weeks, we could get some pretty nasty weeks where portfolios go down in value. And that's really to do with rhetoric that comes through around inflation and interest rates, which will primarily drive that. And I guess kind of energy prices or commodity prices that sit in the background. We'd always repeat, and I think it's true, you know, when you get a crisis like this, you know, you have to look at it over the medium and longer term. So, and what you might say is that as an investment manager, you have to kind of look through that. You know, we're not going to suddenly change tack, and we're not going to be buying commodities or trying to get something that gives us a short-term return. It really is time to stick to the guns and say, well, look, this is what we think is a good thing for the medium and longer term. So the other thing, I guess, within that is yes, the news around inflation should be the primary thing that drives our interest as a consumer, because anything that keeps pushing that number up is likely to have a negative impact on investment markets. Not guaranteed, of course, but likely. And anything that sort of eases pressure on interest rates a little bit is likely to be slightly more favourable, or has the potential to be more favourable. Is that kind of a fair summary of where we're at today as from an investment perspective?
Yes, so I think definitely over the short term, it feels like inflation and inflation expectations are probably going to drive markets.
Yeah,
it feels like just kind of anecdotally, the agenda or the rhetoric has shifted from the Russia and Ukraine crisis, where it no longer is dominating newspapers and news flow like it was very much, and quite rightly, by the way, like it was very much through that end of February and March time.
Yeah.
Now the market and people are very much focused on inflation and central bank interest rates. Now, yeah, it looks like inflation will go to 10%, but clearly interest rates will not go to 10%.
Yeah.
That's just not going to happen. So everyone is now looking out and trying to interpret the minutes that we've read from the meetings from the Bank of England, the Monetary Policy Committee there, and the Federal Reserve, and it's just about trying to understand how high interest rates might go, how high inflation might go. And I think one of the things that might be a relief to the market is if we start to see signs from the Federal Reserve or the Bank of England that actually they're not going to raise rates quite as far as they've indicated. And there's this idea really at the moment that some people view that the Federal Reserve are trying to make their bark be kind of louder than their bite. So they make it sound like that they want to raise rates a lot to kind of bring inflation in. But when it comes around to it, that ideally they won't have to raise rates too much, and the inflation comes down, and then they can kind of go on with their previous kind of lower for longer type regime.
A missell of the intention of where they're going to go with to try and curb public behaviour, I guess, is what it amounts to.
Completely.
Yeah.
Yes, yeah. Exactly.
Okay, so we should be watching out for that, and you know, obviously what happens with inflation here in the UK. I think that's been really useful, Henry, and you know, appreciate you taking the time to do a bit of an update. You know, I think if clients are worried about the detail of their own portfolio, they should absolutely contact their relevant financial advisor here at Carpenter Box. You know, very aware that it's a challenging time, and more than happy to talk through things individually as required. But Henry, for now, thanks very much for your time.
No problem.
I appreciate you doing that today. Thank you.
Not at all. Thanks. Cheers.
Thanks, Henry. Bye-bye.